If you talk about individual shares in a portfolio, do you have a rule of thumb or any sort of formula you've seen over the years, Steve, of like how much is too much to have in one single company?
Depends on how much money I suppose you've got, but like a 5% rule is pretty good. Yeah, if you got more than 5% in one stock, you got of the total, and this is just your share portfolio. I'm saying, I think that's got to be a limit. Often, most fund managers are exactly the same. So every fund manager will have limits on how much equity they can have in individual stocks. Like Tesla was the ultimate example of this. Every fund manager under the sun jumped on Tesla. It went up astronomically. They were forced to sell out because if the fund manager has a cap of say 5 or whatever percent they have, although they thought it was going to continue to go up, all the fund managers had to start selling because they've got a cap of how much in each individual stock. I think some people think that they just endlessly can have as much as they want of one stock. They've all got risk mitigation strategies, and that will include
Welcome back to the Winners Playbook. Josh here with Steve. Today we're going to be talking about DroneShield. It's a business that has run hard this year on big orders and headlines, then dropped fast when doubts popped up. It's a good reminder that single stocks can be exciting and scary at the same time. We'll keep it simple today. We're going to be pulling out the money lessons and what will actually help you in terms of your own personal planning into the future. But before we get into that, Steve, what's the latest in your end, mate?
Mate, the latest business, it's a fast lead up to Christmas now, and we've actually been nominated for a lot of awards. Yourself got nominated for Inside Network's 40 Under 40 Entrepreneur of the Year. That was amazing. You took home the gong, so well done, mate.
Yeah, that was good. It's good to finally get one.
Very good. And next week, we've got 7 nominations at the IFA Awards, so it's very exciting times for the business.
Yeah, you'd like to think we're going to clean up a few next week. We haven't been too lucky at the IFA Awards so far, so this could be the time, huh?
Could be the one.
So maybe that shelf behind you will be full of trophies as of this time next week. Let's only hope. But it's lots obviously happening towards the back end of the year. Business is going well, and 2-3 weeks, and we're closing now. So it's been a big 2025, and 2026 is going to be just as big, if not bigger. And hopefully we'll get into that new shiny office at some point in time in the near future, which is causing us a few headaches at this point in time. But it's all part of the game, isn't it, Steve?
Few and expensive headaches, unfortunately. That's all good fun.
Yeah, no, it's a part of it. But then, last podcast I did with Billy last week. For anyone that was listening, I had a crack at building a veggie garden. Steve didn't believe me with regards to how well I've done here, but I'd appreciate some thoughts and feedback for anyone to go check out my TikTok. And I've got about 13, 14 tomato plants brewing out the back at this point in time. So look out for the harvest. Here we
go. Look forward to it.
But breaking down the DroneShield situations. This one's always a really good reminder of the key risk of when you invest in individual companies, particularly when you're not, you don't really steer the future of that company. You're just buying in on a listed company, and you own a very small portion of it. So I want to sort of talk a little bit about the facts, Steve, and then we'll dive into breaking down some of the ins and outs of it. So basically, the company DroneShield, what they do is they created some tech that basically helps disable drones. And this one's really relevant and was really, the timing of it quite hot with the Ukraine-Russia conflict that started quite a few years back now. Well, that's gone quick. And so the company's really boomed. And at the beginning of the year, they opened at 58 cents and hit a high of $6.70 in October. So, they had astronomical growth. I remember seeing this come across my desk actually at one point earlier in the year. I think it was in the dollars, and I didn't nibble at it, and I probably regret it at this point in time, but since then it's come off quite a bit. But it had a really good run up into October, and that's when it hit its peak. But then lo and behold, just in the last month, basically what's happened is the CEO, the chairman, and some other key personnel within the business have come out and basically taken $70 million off the table. So they basically sold all of their available shareholdings that they could around early November. and the CEO in particular took $50 million off the table, which is a huge amount of money on around the 10th of November. And the interesting part to it is around that date, or on that day when it happened, the company actually announced like a positive announcement, and anyone that buys direct shares would know what that means. Sometimes the companies will go into like a trading halt pending an announcement that's going to come out, and that's either usually good or bad. And then if it's good, the share price goes on a bit of a run, or if it's bad, it comes down from there. And an announcement came out, and it was quite positive that a new contract was won. And so the shares went on a bit of a ride, and that was actually when the CEO and the others were selling out. And then lo and behold, a few hours later, they actually came back out and corrected the announcement, and it wasn't in fact true. So yeah, a lot of moving parts to this one, and naturally, because those shares have been sold off by a lot of the key owners in the business, the share price has come off quite hard, and it's gone from $6.70 in October, $6.70 a share, down to, as of right now, sitting at $2 a share. So, if you've been buying in the last couple of months, you're not going to be happy. And notably, obviously, the business has got a lot to answer for, and I think it's still going to sort of unfold how that one plays out, because there's a few question marks around the timing of, the CEO and other directors and so on selling out. But yeah, we're going to be sort of diving into that. But how do you react to that, Steve, when you see it? You've been in the markets a while. What do you think when we see those things happening?
Well, it's not great because it loses consumer confidence, right? Like we don't like seeing that type of stuff because, especially when you see large, big shareholders or CEOs, etc., taking their equity off the table, it generally is not a good sign, because why would the seniors take their equity off the table if they thought it was going to go up in future value? They wouldn't, right? So it is warning signs. That's a huge mistake. It'll be interesting see how ASIC deals with that, because when you release information to the market, it is super sensitive and it's got to be right. So getting it wrong, clearly on top of that, when you're selling lots of shares at senior management level, something doesn't add up. So that's unfortunate. It's pretty rare. Fortunately enough, we've got a very well-governed financial system where that is pretty rare, but it does happen. And we've got to just make sure it limits, because as I said, it does limit consumer confidence.
And like, I think Billy actually mentioned on the podcast last week that, shares take the stairs up, but the escalator down. But really in DroneShield's situation, they probably took the escalator up and the escalator down, because they've gone up so hard, and they've gone up and then down in the same ride. But yeah, the big key part is that like poor communication from the company, and a little bit sketchy in terms of the information that's really been coming out. But yeah, like you said, the big one there is really those key personnel taking money off the table when it's not I think the business has only been around since 2018, 2019. It's not too old of a business in itself. So yeah, seeing the CEO and key personnel take that money off the table is not great. But then I guess the other element of it, which I think is worthy of commenting on, because I've been reading up a bit online about it, and I haven't seen too many people sort of comment on the fact that it's also a very big risk for business owners. They generally hold the mass majority of their wealth in that single company. So if you flip it from their end as well, you got to understand from their side of things, at some point in time, business owners do want to take money off the table, as opposed to having all of their life, and all of their wealth, or the mass majority of it, probably built up in one single company, which is incredibly risky, and particularly when it's a listed company as well, because sometimes, the markets react in weird ways, and even if your business is going well and it's cruising along nicely, sometimes it's open to manipulation, and it just can fall out of favor. And if all of your wealth is tied into that one company, which is going to be the topic we're really talking about today, which is really risky when you're investing in direct shares. I think if, I try to put the hat on of being in their situation without knowing all of the facts and what's going on behind the scenes, there is also an argument to say that, well, fair enough, at some point they're going to want to take some money off the table. But I think if they come out and sell all of their shareholding, that's probably not a good look. So if they took a third off the table, that might be a different story. So I'm trying to think of the positives here for them. But yeah, when you come out and take all of your equity off the table, probably not a good sign. Don't you reckon, Steve?
No, that's right. I think you're 100% right. Like, it's clearly, from a risk perspective, you want to take some equity off the table. At some stage, you're taking all of it off the table. If that's the case, then that would be pretty big warning signs, I would think.
Yep. And what about if a share's running hot What are you typically looking at there to sort of see if like is it real or is it a bit of hype? Like what have you looked at over the years when you're seeing share price get on the move and you see it all the time? What are you typically looking at to try and substantiate it, or is it real or is it just hype?
Yeah, I think firstly you got to look at the industry they're in, because for instance, technology and DroneShield's probably in that tech slash
Yeah.
infrastructure space, right? Tech can run on zero revenue, right? So you got to look at that, and if that's the case, it runs on, technology stocks in general can get blown up valuations like there's no tomorrow for no reason. So you got to be very careful when it comes to anything emerging market, etc. So you really look at the industry it's in, what type of type of industry, etc. So that's your first step. And then secondly, if it's not tech or not just getting blown up because someone's made a comment online that look it's going to make it fantastic, then sort of get under the cover about why it's run, and they might release some really good profit results. Like the revenue might be right up, and that happens. They disclose that they've got 25% revenues, and that's why it's done, and that's a really good thing. So you just understand the fact. There's lots of areas you can go to online, Yahoo Finance, etc., to work through that, and often it'll be pretty clear, to be honest, like why it's run. So, and if you think it's run because some for no reason that doesn't make sense, you probably want to, if you hold it, potentially getting out of it.
Yeah, those were the only points I'd noted down. Like I was going to say, like really talking about those fundamentals, which, like you said, sometimes in tech, it gets a little bit out of whack because these businesses aren't even profitable a lot of the time, and they've got exponential growth in revenue, but they're just churning through, all these expenses and not even making any sort of a profit. And sometimes those valuations get so way out of whack. And and ensuring it's is this thing a short term fad or does it have actually longer term potential? And I guess in the example of DroneShield or talking about like defense ETFs or defense stocks, unfortunately, like the world doesn't seem like it's settling down anytime soon, and conflict's always going to really be around. And we've talked about it a few times on a podcast this year. Some of those defense ETFs, and we spoke about when we were over in the US a couple of years back, and we had that keynote with old Kevin Rudd. Someone asked him a question in the crowd and said, "What would you be investing in, or what should you be looking at?" And he certainly said defense ETFs, and I think you even slotted in a bit of money there, Stephen, done quite well off the back of it.
Yeah, DFND is the one, the ticker. And I got in, you didn't, so I'll take the.
So you owe Kevin Rudd a dinner or a lunch, do you, or what's the go?
Happy to take old Kev out for dinner based on that little hot tip. Yep, very much.
Yeah. Well, it's interesting though. Like when you look at that key risk in buying individual companies, like I think what you've done there is buy an ETF which owns a basket of companies is probably a safer play rather than you're sort of speculating in one company, where these are the risks that happen with one company as things like this can happen, manipulation, individual key person risk. Whereas if you're investing across 10, 20, 50 or 100 or 1,000 companies, a lot less risky.
I understand. It means you don't have to watch it every day. I don't have time to watch the stock market every day. So unless you're going to sit there and watch it every day, then I'd say forget it. Unless it's a blue chip, like a blue chip, individual stock, you could not have to watch that all the time. It's just going to turn over and make its 7% annual increase in revenue or whatever it may be, and away you go. But yeah, if you're going to go into stocks individually, like DroneShield or quite not blue chip market, you need to be on the pulse big time, or have a stockbroker that's on the pulse big time. Someone needs to be watching it real hard. My view is always diversify through ETFs, managed funds, etc. First, set yourself up first in that regard, and then if you've got time on your hands, you want to go into that into individual stocks after that. So be it. That's all cool. But I think investors out there should just set themselves up through good ETF portfolios, right? Diversify hard across them. And do that over a period of time and build up your wealth that way.
Yeah, it's hard work when investing in direct shares, and I say it a lot. Like most people generally start by investing in direct shares. Noel's no different, and it's very difficult. Like you really are speculating unless you're a Warren Buffett in the making. You know how to read all the updates, and you enjoy reading the announcements and balance sheets and profit and loss, and you can actually understand what's going on. It's not easy, but other warning signs to look out for. Like we've already spoken about, key shareholders taking equity off the table is something to watch for. Poor communication out of management. That's one that, ASIC's going to have to look into in terms of like the communications that they've been putting out. But one I always think about as well is, when stocks start to get overhyped and everyone starts talking about it. And what I mean by that is like, you're at a barbecue on the weekend, and then, the people that aren't even in finance start talking about DroneShield or a particular stock or Bitcoin or whatever it may be. It's like that when they say when the cab driver starts giving you stock tips, like, it's probably a little bit overhyped. And that's one I would always look out for when you see people just piling in and then you ask them why and they can't really give you a reason for it.
Yeah.
That's always a big risk. And another one I was actually looking at, which I haven't looked at for some time because I don't do much stock picking myself these days. I own a few little direct shares, but not many. Like yourself, I do a lot of ETFs and manage funds. But one thing I used to look at a lot was the amount of shares that are short on the stock market in individual companies. And there's a website you can go on called Shortman.
Yeah.
And it basically shows you the amount of stock that's held on short at any one point in time. So I was actually looking at DroneShield. I was just curious to see what that one looked like. So right now, about 6% of the stock is short. So it went from approximately 12 million shares that were short around August, September, now up to about 55 million of the shares. But it's worthy of noting there's about 909 million shares on issue, but about 55 million of those shares are currently shorted. So when you're seeing if you look on the ASX Shortman and you look at the shorts rising, that's basically sentiment saying that people are thinking that this business is going to come off in the near future. And could you maybe just briefly describe how that shorting works, Steve, and what that represents and why it's, worthy of understanding?
Well, shorting is where you're virtually betting that the stock's going to drop. Okay, so you're taking a position lower, and if the stock drops, you win effectively. And the people that lose are the people that are thinking it's going to go long or go up in value, right? So you effectively it's effectively gambling, right? I suppose, but and people are rightly so can take that view. It's exactly the same as thinking it's going to go up, just the other way. So if you can take positions in any stock, pretty much any stock these days that you think it's going to drop. It does create issues in saying that it then creates an atmosphere where it's like the guys who want to go up are sort of competing with the guys that want it to go down. And sometimes you get commentary floating around that can be very misleading and very confusing, and that I don't think they've ever really been able to manage that, because you get a lot of forums online that people believe, mums and dads out there, media gets it wrong all the time. Nine News, I had to say it, but some of the stuff they release is garbage. So, anyone can put anything out there these days and it gets picked up and all of a sudden the stock drops and then the sellers, the short sellers win. So, it's an interesting one, that one. But effectively you're just betting it's going to drop.
Yeah, it's a good point. You got to be really careful on where you're consuming that media. And I suppose if you're really getting all of your information from media, you probably want to get multiple media sources and scour the whole, internet and universe there, because you could be quite easily getting a lot of your media from a fund manager or whatever the outlet is. And, they might be short on a business or taking a different view, and therefore all of what they're going to be putting out because they want the company to go down. Well, what do you think all of that news and media is going to look like? So, I haven't looked at in the shorts on a company for quite some time, but I thought it was interesting to actually look at how that's gone up. So it's still sitting quite elevated. It was quite elevated back in February, but then the company's just absolutely taken off since then. So it's worthy of noting if all of those short sellers would have just been getting burnt as the stock's been climbing over that time. But the ones that started going short around sort of August, September, when the stock then hit its peak in around October, they would have creamed it in. They've made a heap of money. So it's worthy. Yeah, it's good to highlight. There are some managed funds and ETFs out there that do take sort of long and short positions, and this is how you can get some sort of exposure in these ways. But if you talk about individual shares in a portfolio, do you have a rule of thumb or any sort of formula you've seen over the years, Steve, of how much is too much to have in one single company? Do you have a rule of thumb there, or?
Look, I think the general rule, it depends on how much money I suppose you've got, but a 5% rule is pretty good. If you got more than 5% in one stock, you've got the total, and this is just your share portfolio, I'm saying. Your share portfolio, I think that's got to be a limit. Often, most fund managers are exactly the same. So every fund manager will have limits of how much equity they can have in individual stocks. Like Tesla was the ultimate example of this. Every fund manager under the sun jumped on Tesla. It went up astronomically. They were forced to sell out because if the fund manager has a cap of say 5 or whatever percent they have, although they thought it was going to continually go up, all the fund managers had to start selling because they've got a cap of how much in each individual stock. I think some people think that, oh, they just endlessly can have as much as they want of one stock. They've all got risk mitigation strategies, and that would include that you have to have a cap on individual stocks, so everyone does that. So yeah, look, my gut feel, and it's probably me personally, is a 5% rule. If you go above 5%, you're sort of getting into a point where you could really damage the portfolio if it goes to crap. But again, you probably got to look at what sort of industries they're in. Are they blue chip, not blue chip? Is it tech? So yeah, if you're going to buy BHP or Rio Tinto or Fortescue or Woolworths, yeah, it's probably less of a risk, right? But I'd still stick to the 5%. My view. How about yourself?
Yeah, no, that's exactly what I had. No, because I think you'd put like companies like this, like you're saying, probably a bit more speculative.
Yeah.
This sort of a company. So you might put that in your high risk basket of investments where you might have the overall portfolio sitting at 5 to 10 or 15%, not just sitting in one company, but across, some of those more speculative or specky risky options, which, can go from 50 cents to $6.70 within like 9 months, like DroneShield did, but they could also come crashing down just as quick. Or I've seen companies get delisted before. I think one of the first ones I ever purchased was a gold company, and I rode that thing up, and then it came crashing down, and then I managed to get back out at the price I bought in for, and then I think a year later it delisted and got taken off the share market. So I'm thinking we've all probably had one of those.
I've got a prime example. I bought OneTel, which was I got injured in a ski accident and got an insurance payout. I put it all on OneTel, which was owned by James Packer and Lachlan Murdoch at the time. I thought, this is a no-brainer. It's got to go with those two guys. Within a year, was bankrupt and delisted off stock exchange. I lost every single dollar.
No kidding.
Totally. And that was my first stock I ever bought. So that was a good lesson in life about risk mitigation and diversification.
Yeah, I remember when I first started share trading and buying shares. This is actually when I was a concretist. This is getting back. And there was a guy that I knew in the finance space through my boss, and I was always asking him like, "Oh, what stock should I be looking at and buying?" And he always said like, you're not really experienced, or you need to feel a loss. Like you got to lose some money first to truly understand what's going on. I never really understood that until I actually lost some dollars, and then it's like you said, like you take some good lessons from that.
Yeah, look, I take it as an investment, right? It's an investment in just education, and it teaches you so much when you do that. So, hopefully it doesn't happen again. But we'll take it from there.
Well, fortunately in Australia as well, if you do make a bad investment, you actually get to carry forward those losses. So that's one thing. That's a good tick on the ATO, because normally we give the ATO a bit of heat on the old podcast for some of the things that they do and the government. But that's probably one of the good things in the Australian tax system. If you make a loss in the investment, that can actually offset future gains on other investments you may have, and it carries forward indefinitely. So fair to say you probably would have wiped out those losses over the years.
I probably have wiped out the losses, but yeah. Thanks, Josh.
Yeah, no, that's good. That's good. Well, I suppose in closing, like we've sort of spoke about, like what does good diversification look like? Like that's really how we do it for our clients. Like we're in managed funds, we're in ETFs. We're actually never really stock picking at all, and we're using a well diversified portfolio that doesn't just look at Australia as well. And I think that's what a lot of Aussie investors do wrong, is they go so overweight in Australia, and you've just got that inherent sort of home bias, but you're missing out on so much innovation if you're not investing overseas. And is that your approach to it as well, Steve? With
100%, you got to look outside Australia. Yes, have an allocation to Australia, but look at areas like India. Up and coming economies, billions of people. You got the amount of money to be flowing through there in the next 10 years. Like there's ETFs that you can buy the top 50 stocks in India. Emerging markets, yes, more volatile, but over the next 10, 15 years, 20 years, depending how long your timeframes are, they're great markets, and a lot of listed companies. We've got an issue with Australia and the Western countries where we've got all these companies delisting off the stock exchanges, which is really limiting your options of where to invest in. Or like America, you got 7 companies that make up the mass majority of the index. So, look outside the box, get out of Australia, get out of some of the bigger places, and there's some really good options out there.
Yeah, no, I agree. And in closing, Steve, if someone actually had DroneShield in their portfolio right now, or if you had DroneShield in your portfolio, of course, not advice because we don't know anyone's situation, but what would be your next steps if you had it in your portfolio at this point in time? Like, what would you be thinking about?
Look, hopefully it took some money off the table at the top end of when it hit $6, whatever it was. But look, you take a look. I'd probably be holding it. Now it's dropped so much, you generally don't want to sell it, especially if you bought in above what the price is today. It's probably it's in a good industry. They obviously know what they're doing, but just make sure you limit your exposure over time, I suppose.
Yeah, I think a good point. And yeah, providing you're not in a position where you're forced to sell like any investment, like you never want to put yourself in a position where you're sort of forced to sell. So assuming that's not the case, well then you just got to really sit down and think like, are you a short-term trader? Are you a long, which you're speculating probably, or you're more of a longer-term investor? And then, look, I think I'll generally agree. Like if unfortunately, if you just look at the world and the way that it goes, like over the years, just new conflicts are always popping up and arising, and global powers are going at each other. And yeah, that's why you've just seen such a big tailwind behind this, defense and tech sector over the last 12 months. And sure, does it cool off at some point in time? Maybe, but I think because it's in that tech space where there's always this innovation, and I think it was mentioned as well. I think the CEO has come out and said a few things, not much, but I think they're still very bullish and put out some communication on what they're expecting for the future. So the share price has already recovered a little bit from how low it got after those announcements. But maybe there is some blue skies ahead. I certainly don't hold it personally myself, but for anyone out there, hopefully that has actually added some value. But yeah, other than that, in closing, Steve, any final remarks before we call it?
No, look, I think, just diversification is key, absolutely key. You got to do it. Build up, I'd say just build up your portfolios first with ETS managed funds and just get that moving. And, once that's all done and you've got the figure you need, then sure, go to individual stocks. But there's so many good options just and keep it safe.
I totally agree. Well, Steve, it's been good to have you on the podcast. It's been a while since we've done a podcast, hasn't it?
It has been, yeah, it's been good to be back, mate.
Yeah, no, it's good. Well, it's good to have you on here. And yeah, everyone listening, if you're getting value, 5 stars, Spotify and Apple. And of course, if you want to chat about your own personal situation with any financial advisor, if you want to chat to anyone at Link, just jump on the Link Wealth website and you can take your pick and book in for a free 15-minute call with any of the advisors. Or if not, reach out to your own advisor or have a look on the net to find an advisor that suits. But until next time, Steve, enjoy the weekend, mate.
Cheers, mate. Same to you. Bye.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.